Paul Krugman says Silicon Valley Bank was a kind of affinity fraud a la Madoff because it sold itself on false pretenses. We at Cryptocurrency Demystified have looked at the article by Zinnia Salfidi about Silicon Valley Bank and have to agree that if what he said they were doing is true, they were doomed to fail. Many of the YouTube community will be affected by this because ST was a depositor at this bank, and some folks were not able to get paid for their work on the platform today. Roku was also a depositor at this bank. Paul Krugman said what SB actually did was a kind of affinity fraud a la Madoff. SVB convinced tech startups it was trustworthy by selling itself under false pretenses, according to him. The Nobel Prize-winning economist is frustrated with this delusion marketing that includes the crypto industry too. Paul Krugman is taking issue with how Silicon Valley Bank portrayed itself to the tech startup world over the years, saying the lender relied on false pretenses to gain clients' trust. In an 8-part Twitter thread, the Nobel Prize-winning economist argued that SB calling itself that the only bank dedicated to the global innovation sector was a marketing tactic above all else. In a deep sense, though not a legal sense, what SVB actually did was a kind of affinity fraud a la Madoff. It managed to convince the VC/startup/crypto it's a world that it was one of them, part of their community, and hence trustworthy, Krugman tweeted. But it is infuriating. At a fundamental level, we're arguably talking about a kind of scam, a bank that sold itself on false pretenses. It's really part of the larger story of delusion marketing that includes crypto, he added. Krugman was referencing Bernie Madoff, the widely respected financier who pulled off the largest Ponzi scheme in history when he managed to convince investors to hand over billions of dollars of their savings by falsely promising them high returns. While SVB was a bank dedicated to startups, that's not where it made most of its money, Krugman said. The bank attracted its clients' deposits and parked them in long-term securities, an investment strategy that went very wrong. And in fact, longer-term securities paid more than short precisely because there was a one-sided risk that what had happened would happen, that short rates couldn't go down but could go up. So this wasn't a brilliant investment strategy, just unacknowledged risk-taking, Krugman said. So what was all the dedicated to global innovation stuff about? Some real business, but largely, I think, a form of marketing, a way to sell crypto, startups, etc. on the idea that SB was their kind of bank, and hence a place to put large uninsured sums, he added. He also noted that SB successfully lobbied to weaken regulations that were put in place to safeguard banks, which might have prevented the blowup as former Fed Governor Lael Brainard warned back in 2019. It seems to us that then Fed Governor Lael Brainard was correct that Section 401 of the Crapo bill also, by changing one word in the federal code from may to shall, enabled the Federal Reserve to weaken rules further for the stadium banks. In 2019, using this tailoring provision like Republican supporters of the law urge, they removed the modified liquidity coverage ratio from banks under $250 billion like SVB, a similar kind of emergency measure as in the enhanced regulatory standards. Then Fed Governor Lael Brainard condemned this reduction in core resilience. SV was closed down and taken over by U.S. regulators on Friday when the firm, once a trusted lender for startups, saw its stock price collapse after it failed to shore up $2.3 billion in capital. The Fed, U.S. Treasury, and the FDIC said they would fully protect all the depositors who had funds since SB. But Krugman said there seemed to be enough systemic spillover for the Fed to have to step in and backstop deposits. The good news is that the FDIC has seized the bank, so the stockholders have been cleaned out. Unfortunately, there seems likely to be enough systemic spillover that the Feds will probably have to backstop some, although maybe not all the uninsured deposits, he tweeted. Krugman's tweets come after previous comments he made about SB, where he was optimistic that the lender's implosion wouldn't trigger more bank failures. So you have depositors that either didn't know the first thing about risk management or were bribed by the bank into neglecting it. And you have a bank that didn't have a chief risk officer for close to a year that put their entire risk management on autopilot and got blindsided by interest rate fueled losses. Interest rates do two things, they go up and down. SV did not foresee and manage properly that inevitable thing, Porter said. Let's not forget the terrible supervisory job of the Federal Reserve, SB's primary regulator in all of this. Not only did their interest rate spikes cause this problem, they failed to recognize obvious threats from SB's balance sheet. The enhanced regulations were put in place to remove regulatory discretion. Instead, SVB lobbied for it and got those regulations removed, and the Fed went back to laissez-faire supervision. SVB's losses aren't really that major in the grand scheme. The haircut that depositors would take under normal rules would be minimal. It might take a minute, which with payroll being due was a risk startups didn't want to take. But they have well-heeled benefactors. The VCs shouting about the end of the world, who could have supplied whatever bridge support was needed for companies they still profess to believe in. Instead, we now have this extraordinary scenario of bailing out the entire deposit base of the United States in one shot. The banking system has been utterly transformed overnight to prevent a threat that should have been easily avoided with basic risk management among SVB and its customers. In effect, depositors at SVB got all the upside of banking there, paying nothing extra to lighten the risk of failure, and none of the downside. Privatized profits, socialized risks. The most interesting thing, we have analog banking reg in a digital world, Porter said. How do you cope with that? How do you build regulations to reflect that? If these failures are going to occur more quickly, then the tools of defense and protection to guard against that need to be stronger, not weaker.